Good afternoon, everybody, and welcome. I'm here to open up this session with a brief overview of the M&A landscape for the marketing services sector. But I thought I'd just start with a few words about who Kingston Smith are. For those of you who were at the welcome cocktail last night that we hosted, basically you'll know we've got a very nice office in London's West End, and we make a mean Negroni. But other than that, we are a leading top 20 UK professional services firm. We provide audit, tax, advisory and consulting services to the media and marketing services sector. We're also a founder member of Morrison KSI, which is a large global professional services association with 375 offices in 88 countries. In the UK, we've got 6 offices of our own, and we've also got an office in LA. We have a partner-led team. We're focused on key international markets, looking to invest in the UK with a media sector focus, principally US, China, India, and Latin America. And most importantly, just last night, I found out that we were voted Best Mid-Market Media M&A Advisor in the 2016 Acquisition International M&A Award, so I'm particularly happy about that. Anyway, since 2014, what we've been doing is compiling a database of all media and marketing services sector transactions where either the buyer or the seller or both is UK-based. And we're obviously branding experts, so we've called this thing the Kingston Smith Deal Tracker. And it's entirely free to use. It's available on our website. The web address is at the top left-hand corner of the slide there. And anyone using it is able to filter deals by participants, by sector, by country, and so on. Where prices are revealed, which they quite often aren't, we record that, and we also try and link to official press releases wherever possible. So it's quite a useful tool, and as I say, we use it to track what's happening in the sector, and much of what's to follow comes from our analysis of those transactions that are captured in the Kingston Smith Deal Tracker. But as I say, please do go onto our website and have a play with it. Now, our deal tracker captures deals across the entire media sector, so as well as advertising, marketing services, we look at publishing, television, film, and so on. But for today's overview, I've isolated deals that only relate to marketing services and media technology businesses, which are, for our purposes, essentially technology-driven marketing services businesses. And the picture that we see is of a pretty healthy, active market here in the UK. With some 150 to 200 deals being done each year. However, there are perhaps some signs of a slowdown in the UK in the second quarter of this year, as you can see from the chart there. The mathematically minded will see that the chart isn't entirely fair because it only covers deals up until the end of May 2016, so it's only 2 months of the second quarter. But having said that, I'm not expecting to see a mad rush of deals completing in June to bring it right up to previous levels. Actually, I'm tempted to suggest that this is the very real possibility of Brexit having an effect in our sector. Certainly, anecdotally, I'm aware of 2 transactions involving a UK seller and a French acquirer where the deal's been put on ice until we get the results of the vote next week. And 4 weeks ago, I would have thought they were just being super cautious, and now I'm not so sure. Of the 58 deals that we covered in the first 5 months in 2016, approximately 1/3 are deals that we would classify as media technology, while 2/3 are perhaps more traditional agency businesses, albeit these themselves might have a strong tech component. It's not always that easy to distinguish between the two. Regarding who is buying, Dan and WPP have been the most prolific buyers in our survey this year so far, with 7 and 6 new acquisitions respectively. And what are they buying? Perhaps unsurprisingly, when we further analyse the marketing services deals, we find that digital agencies account for more than 60% of transactions. So digital is hot, it has been for some time, and it continues to be so. PR and media buying also feature very strongly, but digital sweeps all before it. And obviously digital covers a multiple of different offerings, so we've tried to analyse that further and found that along with full service, data and analytics capabilities are most in demand. And actually that's quite interesting because in 2015 we found that performance was far and away the most popular digital subsector, but that seems to have completely swung in the last 5 months towards data and analytics. This infographic, it shows the origins of buyers, which are on the left-hand side of the circles, and sellers, which are the right-hand side, for cross-border transactions involving the UK. So where I showed you the deals before, that involved all deals, including those where UK buyer to UK seller. This is just those that are cross-border. And 70% of the deals that we cover are in fact cross-border. Of our cross-border deals, 41% involved an overseas buyer, 59% therefore an overseas seller. And this underlines the strength of a number of the UK-based buyers. As I already mentioned, our survey covers the activity of prolific acquirers like Dentsu Aegis and WPP, and they've shown no let-up in expanding their portfolios in the first 5 months of this year. We've also seen more activity from US performance marketing giant Merkle this year, with the acquisitions of DBG1 and Comet Global Consulting, following on from 2015's Periscopics. So far, we've looked at the volume of deals being done, who's buying, what they're buying, but I actually thought it might be interesting here to address how they're buying. Because over the past decade, what we've tended to see is people buying 100% of a business on day one, but paying for, say, 60% of the value, with the remainder contingent upon performance over the next few years. That's a so-called earn-out model. And the variation on that theme is where somebody buys 60% of the shares, say, on day one, and then buys the remainder in at pre-agreed waypoints over the next few years. However, in the last couple of years, we've seen a resurgence in interest in partner-type or venturing arrangements, where the larger groups are acquiring an initial stake in a business, but leaving management with a significant holding and no contractual arrangements to acquire the remainder in the future. We've seen that with a number of transactions where we've advised, involving acquirers such as MDC Partners and WPP. And you can see why acquirers might be interested in this model. There are benefits in having management retain ownership in the business they actually run. They become genuine co-owners, and when dividends are paid, they receive their fair share. Conversely, if performance does not merit a dividend, there's an instant and direct result for them. And this chart relates to some research earlier this year that a colleague of mine did into the performance of operating subsidiaries owned by the top 50 UK independents. 11 of those companies have subsidiaries with a substantial minority stake held by the people who run those subsidiaries, and that's particularly prevalent in the larger independents. It includes people like Rittel, whose 6 subsidiaries are part-owned by their management. It includes the product designers Seymour Powell, the packaging specialist Williams Murray Ham. The And Partnership has 2 subsidiaries with substantial minorities owned by management teams. Emerge, AKA Group, Freud's, it goes on. 4 Communications and Oliver, they're all among those that have management owning a substantial minority in operating subsidiaries within their groups. And as this chart shows, that strategy seems to work. The groups that have offered a direct stake in an operating subsidiary are more profitable and grow faster. And we would contend it is this correlation that may be driving the increase we are seeing in this sort of structure being employed by serial acquirers. So that is something new. I'd be interested to see if other people have come across that sort of arrangement. Anyway, I hope that serves as a quick overview of the market. I've got 2 minutes to give to Esther on top of her 10, so that's good. Esther's going to be looking at what constitutes an attractive agency within the broader market.
Thank you, Nicola, and much appreciate my extra 2 minutes. So clearly, if you've got aspirations to sell your business, then you need to make sure it's really attractive to a buyer. And obviously, there are lots of different qualities that make a business attractive. And what I want to focus on this afternoon is just some of the financial qualities, obviously, which I think is pretty key. Now, obviously, your financial performance is all relative. It depends how the rest of the market's doing. It depends how your competitors are doing. And that's why Kingston Smith have, over the last 25 years, been tracking lots of financial data from agencies, whether that's independent or part of a listed group, from advertising, PR, digital, direct marketing, design, and media buyers, trying to think of them all there. So we've been tracking all of that information and putting it together and looking at all the KPIs that come out of that. And we use that a lot in benchmarking for our clients, helping to set targets and helping to compare them to their competitors. So it's some of that information that I would like to share with you this afternoon. And looking over, I think it's interesting to look back to the last 25 years. So this chart just shows the percentage growth in fee income. You might call it revenue, you might call it gross income. And as you can see, there are the obvious sharp dips post-recession. But also you can see that after each recession and recovery, the rate of growth is slightly less than it was before, which is worrying. So I'm hoping that when we look at the 50-year trend, that's not going to continue. Otherwise, we're all going to grind to a halt. Obviously, growth is really important to a buyer. And if you're able to show a successful track record of growth and you're able to demonstrate that growth can continue post-acquisition, then that's going to help you demand a higher multiple on your profits. And I think it's really important to always plan specifically for growth as well, because I think if you don't, you end up going backwards. So make sure that you've got a well thought out approach to how you approach your new business and how you do your pitching. And make sure you're selective about who you pitch for as well. Who is it that you want to work for? Where is your skill set? Don't spread yourself too thin going around pitching for everybody, because it's time consuming and it's expensive. Now, if we plot the history of the operating profit margin, and by that I mean your net profit before tax as a percentage of your fee income, the line in blue, we see a high degree of correlation to the growth in fee income, which is the line in red, not quite so pronounced, but very correlated. And I think that's to be expected, because I think in periods of high growth, agencies tend to recruit slightly behind the curve, and obviously the benefit of that falls to the bottom line, and the opposite obviously is true. Now, we would recommend that an agency targets a minimum of 15% operating profit margin, absolute minimum of 15, but ideally targeting 20%. And you can see there that the average hasn't hit 15% in any of those last 25 years of tracking it. So I think it is really important. I'm going to mention the word timesheets. I won't get any thanks for that. Make sure you use timesheets, track your client profitability, understand which clients and which type of work make you money and which don't. And be bold and resign those non-profitable accounts if you can't make them work, if you can't get the fees up, or you can't work out different ways of servicing them. I know it's easier said than done. We're a professional services firm. We deal in time and people as well. Now, one of the most significant drivers, I think, of whether or not you achieve a healthy profit margin is the percentage of your fee income that you spend on staff costs. And unfortunately, you can see this ratio has been getting steadily worse over the last 25 years, and at some point surely it's got to stop going up. But obviously, you know, we're in an environment where clients are continually demanding more for less, and that unfortunately is the trend at the moment. You know, digital disruption isn't helping. People with digital expertise are expensive, and that doesn't help. We recommend a maximum of 60%, and that 60% should include your salaried staff and your freelancers as well. Now, unfortunately, these figures here don't include freelancers because that's not publicly available information, and all of our the data comes from Companies House. So by the time you add on freelancers on top of that, that's an even more sorry story. And of course, some people, particularly if you're an independent agency, are going to be taking out some, you know, you might be taking it out as dividends, you might be taking out an inflated salary, but actually when we've looked at it, those that are depressed and those that are inflated sort of balance each other out, so it doesn't affect the averages too much, and it certainly doesn't affect the trends. But yeah, I take that point. Staff cost to fee income ratio is my favourite ratio, so I do it to death a bit. And here we've plotted every single one of the 250 odd companies on a graph, just to kind of really hammer home the point that as your expenditure on staff costs increases as you move towards the right along the x-axis, so your margin goes down. I think it's just a really neat way of demonstrating how important that ratio is. So really you've got to make sure your staff are as productive as possible and really use them efficiently, and know what the full capacity of the agency is. And I'm not suggesting you run at full capacity. I think anecdotally it's better to run slightly below full capacity, and running at it or over it probably means client service is going to suffer. Your profits might go up in the short term, but long term I think that's going to damage growth. Make sure you've got the right mix of your junior to senior staff. Some people I've seen where they're a bit fat around the middle with the middle staff, and actually that can damage your profitability. But you've got to work out what the right mix is for you in terms of the service that you're giving. Make sure your staff know what their target number of chargeable hours are, and obviously that's going to vary enormously from your principals, where it might be very, very low, to your very junior staff, where you'd expect them to be spending sort of almost 90, 100% on chargeable work. And and make sure people understand the difference between good servicing and over-servicing. And I find it really funny that the industry refers to it as over-servicing, which has sort of this positive connotation about it, when actually it's just writing off time. Write-offs, it's not positive, and write-offs is what we call it in the accountancy world. And you know, when I look at the average sort of over-servicing or write-offs, it runs at about sort of 20 to 25%, which is just enormous. Obviously, the use of freelancers is really important within the marcoms industry, and you know, we all know it's absolutely vital to help us deal with the peaks and the troughs of fee income. However, if you don't manage them well, they can seriously damage this key ratio. So I think you need to always challenge whether you think freelancers really are required, whether existing teams can be reorganised, whether work can be shuffled around, and ideally have someone in charge of resource management looking at all of this, and somebody who can be a bit robust with those requests for, oh, but let's just get another freelancer. And it's really easy for your employees to say that. They're not paying for them. And also make sure you're ready to bring in those permanent staff quickly when you're continually using a lot of freelancers. One client of mine calls it their subs bench. They're always having conversations with people out there for who, when the time is right, yes, you can come and work for the agency, but we've got to wait until we've got the right level of income. So it's not a case of starting from scratch, going out there recruiting from cold. They know who it is that they're going to bring in. One of the other key ratios we track is the level of fee income per head, and we say you should target at least £100,000 per head. Obviously, the more senior mix of staff you have, the higher fee income per head on average you should be generating. But then, of course, the higher your average staff cost will be per head. And it's the blend between that gross income per head or fee income per head and the staff cost per head that result in the ultimate ratio of fee income spent on staff costs. So you might have gathered it's my favourite ratio, and if there's one KPI that you monitor in your management accounts, that should be it. So far I've just talked about the average across all the different disciplines. This here looks at all the separate disciplines, so advertising, design, direct marketing, sales promotion, public relations, media buying, and digital. So advertising is achieved above 10% since 2004, after being hit really hard after the 1990s recession. Design suffered heavily in the recession, but in the recent years has climbed back over to 10%. Direct marketing and sales promotion, quite recession-proof in the early years, I think, as markets quite like the measurability of it, but clearly more latterly been heavily under threat from the rise of digital, and where direct marketing and sales promotion agencies haven't responded to that and acquired that skill set themselves, they have suffered. PR, very resilient, very recession-proof, always pretty much delivers a good, solid margin. They have very senior relationships, and I think that helps sometimes with getting bogged down in those procurement discussions. And obviously they've moved into the social media space, and content's becoming more and more important. So I think, you know, they are having a good time. Media buyers, they've maintained this top spot for a long time. It's a slightly different model, but more recently their margins have definitely become under threat, and I think that is partly to do with digital, being wound up here, digital disruption and programmatic. And the recent report about bad practices within media buyers certainly won't help either with the trust issue. And then digital started looking at this separately in 2005. And as you can see, the margin has really, really struggled, only twice getting over 10%, but yet still commands premium multiples in deals because, of course, the talent and the skill set is in demand. And going out there and acquiring is a quick fix. And I think you can see from all of that, I mean, my takeout from that is that the margins seem to be sort of converging on one another, which sort of makes sense as the boundaries become blurred between what each discipline does. I'll skip past that. That's just an average of averages, if you like. So just to reiterate then, sort of just picking out three target KPIs: gross income per head or fee income per head, target a minimum of £100,000. For your staff costs, no more than 60%, including your freelancers, and operating profit margin, at least 15%, but ideally be targeting 20%. I hear you sigh, is this possible, is this realistic? Well, yes, it is. So if we look at the top 10 performing agencies of the independent, so one of the chapters in our survey that we do is the top 50 independent agencies, these are the top 10 performers. A good spread there between design, media buying, advertising and PR, a bit of a conspicuous absence of direct marketing, sales promotion and digital agencies, but between them, they're almost on our target £100,000 ahead. They're exceeding our 20% profit margin, and they're only spending 54% on their staff costs. That doesn't include freelancers, but that gives them a good headroom of another 6% to spend on freelancers to get up to that 60%. So that's what is achievable by an independent, you in the audience. So I think if you can achieve these sorts of KPIs on an ongoing basis, then if you want to sell, you will be more attractive to a buyer and be able to command a better multiple. So just make sure that you monitor all of these KPIs on a monthly basis and just make sure they're going in the right direction. And if they're not, just try and take a step back, take stock and do something about it. So thank you very much. I'm going to hand over now to Dan Egerton, who's going to take you through some of the other ways in which you can improve your value and attractiveness on sale. Thank you.
Good afternoon, everybody. I'm very proud to be here as a sponsor of the first Indie Summit. It's great to see so many familiar faces and meet some new people over the last few days. So just to give you a bit of background about Actus, we're a growth consultancy. We specialize in helping independent agencies accelerate their performance. We do this by providing practical strategic advice to our clients. So it's not all about blue sky thinking, it's about those practical things that you can do to improve your value and maximize your performance. So I've been asked to talk today about how you maximize the value of your agency, a subject very dear to my heart because I've spent pretty much my whole career either working in corporate finance or working as a consultant helping advise companies. And what's really fascinated me is how do you explain that some companies are more valuable than others? And more interestingly, how do you explain that some companies that are even direct competitors to each other are able to command a premium multiple and premium value compared to their competitors? And if you take that into the context of, in theory, they all have access to the same talent, access to the same resources, clients, knowledge, etc. What is it that separates them and sets them apart? There must be something else going on there. And when you're thinking about maximizing the value of your business, the first thing you need to do is think about it from the buyer's perspective. So, shocking statistic, between 70 and 90% of acquisitions fail to deliver anticipated returns for the acquirer. This is the type of context that buyers are operating in. For a successful acquisition, the buyer needs to do a number of things. They need to understand how to identify targets that could transform their company, how much to pay for them, and how to integrate them into their business. A lot of really big, challenging questions for them. And ultimately, what a buyer wants to do is they want to maximize their investment while minimizing their risk. So maximize the return from that acquisition while minimizing their risk. The first step in maximizing the value of your business is you need to understand one simple formula. V equals P times M. Really simple. But this simple formula is fundamental. It's the culmination of your dedication to the business. It represents all those long nights working. It represents the risk that you have taken, the sacrifices that you have made as business owners. And more than anything else, it represents your expected returns and therefore your future financial security from selling your company. So you really need to understand this formula. And what often happens is people very much focus on the P. They very much focus on profit and not so much on the multiple. When you think about profit is all about historic performance, whereas the multiple is all about future earnings potential. So typically, by focusing on the P, you're focusing on how do you command a higher price for what you sell? How do you sell more of what you sell? Whereas what I suggest to you is that you need to focus very much on the M. And the data shows that companies that focus on the M It's a much easier, much more effective and efficient way to dramatically increase your business value. And thinking about this formally, you therefore need to stop thinking about the business and the blood, sweat and tears that you've put into it, and you need to think about it as an asset that has commercial value. This is a very nice graph. I can stand up here without showing a graph. This is a graph showing the EBIT versus time and trying to identify when the optimal time is to sell your company. So if you sell too early on the chart, then you're not going to be able to maximize your profits, maximize the value of your business, because essentially what will be happening is you won't be able to demonstrate the profits and you're proving your business model. If you wait too long, then you also won't be able to maximize the value of your business, because essentially what will happen, especially in an earn-out situation, is if you start seeing your profits tail off, then you won't be able to achieve that premium value for the company. So you need to find that optimum timing. Now, it's very easy for me to say, and I wish I could stand up here and say that and make a big announcement that I have a crystal ball that can tell you all when you're going to be able to find that optimal timing. And unfortunately, I don't. So what you need to do then is start thinking about how do you create that optimal point in time. And that again comes back to thinking about how you look at the 8 value drivers, which I'll come on to in a minute. So critically, this is about your business, but there's also market factors going on, and you need to be aware of those. Now, the first thing in terms of maximizing your value is you need to be thinking about what is the purpose of your business. And companies are generally very bad at identifying that why you exist, what do you stand for as an organization. And it's a very big question. It's a difficult thing to answer. So you need to break it down. And I look at it very much in terms of what are the buyer requirements. Think about those in the context of vision and purpose. What is it that you can, what's going on in the sector? What's happening in the market? What are buyers doing? What are your clients doing? Shareholder aspirations. Again, this is something that gets forgotten quite often, is what are your aspirations as shareholders? What are you trying to achieve? And then what can you be best at? It's not about necessarily changing what you do. It's about learning from what you have and the knowledge and experience you have and taking advantage of that. And then you need to think about all that within the context of, when it comes up, the rewards that the strategy will create, the effort required in being able to deliver it, the capabilities that you have in-house, and the risk that would be incurred by pursuing that particular strategy. So, we talked about 8 value drivers, and let's go through these very quickly. So you have finance. So this is very much about, it's not just about margin and profitability. You've got to demonstrate that you have a strong financial plan. You need to look at the performance of your business very much as a buyer looks at it. Quality of income. So having recurring revenue and multiple revenue streams is critical. And for a buyer, remember, it comes back to managing their risks. So revenue confidence is so important to them. Operations. And if you look specifically within operations at your financial systems and procedures, having that rigor and being able to prove to a potential buyer that you know exactly what your profits are, you know exactly what the KPIs are that Esther was taking us through before, gives them a lot of confidence. Your people and culture, it's so important that you have a strong and motivated management team, that those leaders are able to grow your company and demonstrate to a buyer that that the business can grow even without your involvement if you're the main founder of the company. Then shareholders. So often do I go into situations where somebody's thinking about selling their business and the shareholders suddenly realize that they're not aligned on value and timing and exit plans. So you need to have those conversations up front and early on. And then your clients, customer diversification is key. If your largest customer left, would you be able to survive? Would you be able to cope? So demonstrating to a buyer that you've got that diverse customer base. And I would say no more than 15% of your revenue should come from one particular client. And then positioning an offer, and it's very easy for me to say that you've got to be in the right place at the right time, but you need to look at your market, you need to see what's going on, and you need to be reactive to change. And then finally, new business and marketing. No other metric within a business demonstrates your business model and that your ability to deliver. Now, all that's great, but essentially, smart companies turn knowledge into action. So you need to be able to deliver all these things, but talking about it is fine, but talk is cheap. You've got to show that you can put these in place and also have the measures in place to be able to monitor their performance. And this is a key success factor, and if you take nothing else away from this presentation, think about how you turn that knowledge of what needs to happen within the business into success. And finally, 5 key things for you to remember. So align your organizational objectives and have a clear direction and message. Start planning early on for an exit and prepare like you would do for a pitch. Prepare like you would do your house, getting it ready for a sale. Think about it systematically. Establish a team of experts with complementary strengths to yours. Get your finances in order and build a compelling growth story. And finally, identify a potential buyer early on and think about how that buyer, what they would want from your business, and think about your business through their eyes. Thank you.
So we've literally got 5 minutes for a quick Q&A. So who's got a question? Yes, question front row, ball coming your way.
Oh, blimey. Well done.
Hi, Dominic Pearman from Pearman Media in Australia. I'm not sure if tax laws are different outside Australia, but have you advised many clients on buying their own agency? Because that's what I've done, and it's basically saved me from my marginal tax rate, and I just pay the company tax rate. That's a no.
So it's buying your own agency. What, doing an MBO, you mean?
You can buy your own company, well, at least,
Yeah.
at least in Australia.
I don't see many MBOs actually happen. I think an MBO is something a lot of people talk about and a lot of people think would be a
Not
nice...
management buyout. If you own the company in your own name and set up another entity to buy that company,
I see what you're saying.
right.
Yeah, I mean, it does...
it's not a long-term thing, it's a short-term way of getting money out of your company now.
It absolutely depends on your jurisdiction. But yeah, I mean, there are certainly advantages here in the UK to selling a business than selling to selling a company versus selling a business, for example.
Yeah.
That's certainly, there are tax incentives for that here in the UK.
But certainly in the UK, you couldn't just set up another company and buy your company and get entrepreneurs relief and capital gains tax rates. There are lots of things that
There need to be
prohibit
unrelated
people from
parties.
doing that.
Yeah.
Right.
Yeah.
Yeah.
Hello, this is Klaus from Advance in Copenhagen. I just have one question for you, because we are all looking, of course, to have the right profit margin, 25%, 20%, very nice, but also as a owner of agencies, we all, especially when we are independent, we all the time thinking about investing in the future. We are transforming the agency. I think it's not easy, but it's easier just to focus on the day to day, and we have a good profit right now. But what about the future? So I all the time think we are looking at today, but what about tomorrow? And I think that's. Do you have any reflections on that? Because I think we are all thinking about that. How do we actually build the agency of the future, and digital, social, all that?
Yeah.
Because and it hurts the numbers. We all know that, right? So in my mind,
it can, and as long as that's genuinely why the margin is depressed, because somebody has invested additional resource in building a new business.
Yeah.
If they then got to a position where they were looking to sell their business, people such as myself would actually strip out that investment and say, this is what the underlying performance of the business is, and this is why this has been invested in, this is why that margin has been depressed. And as long as there's a logic and a story behind it, then that is absolutely fine.
Yeah.
And obviously the end game is that with that investment, the margins would come up to their more
Later
normal
on,
level,
in
but
1
on
or
a
2
higher
years
level
or-
of, on a higher volume of turnover. So
because that is actually what we can do as independent agencies. We are able to invest in the future.
And I do think that is partly contributed to the margins being slightly depressed at the moment, is that the whole marcoms environment is going through such a period of rapid change that people are having to continually reinvest. And I do think that is knocking a few percentage points off of the margin, but at some point
Yeah,
it
needs
needs to pay back
at some
correct
point,
itself.
Exactly. From a buyer's perspective, they're going to want to know that this investment that you're making is going to deliver the returns.
Yeah.
So again, if you think about, most deals are structured on an average of previous year's profits for the initial consideration, then you've got to be demonstrating that that average is strong and growing, and it's that growth that they're buying into, that revenue confidence.
Just to follow on that question,
That's a long way to throw.
Yeah, that's hard.
I can't throw it that far. I just want to, it's a quick answer. Building on your answer to that question, how many years does a buyer typically look back? 3, 5 for your average income?
Probably about 3 years.
Okay.
It depends.
Thanks.
In terms of going to market with your business to actually make a sale, would you always advise to go through a third party? Because I often wonder whether there's risks associated to taking yourself to market in terms of the perception that might have for your business with your existing clients that you are ready to sell as in maybe you're not interested anymore. So would you say you always need to kind of do it through a third party so that it's a bit more discreet? You would obviously say that, wouldn't you?
What am I going to say? That's what I do for a living, and so of course I would recommend that you do that. But I do think there are advantages to using a third party as a buffer, actually, anyway, in negotiations with potential buyers. You know, because negotiations can get pretty tense and uptight, and actually having somebody to act as a physical buffer there. But also, if you go through a third party, they may well be introduce you to other prospective buyers, and you have more of an idea of what the market is for your business, rather than there's that one person over there that's shown an interest.
Yeah, I think that's really key. Do not get flattered by the person that comes along and makes you an offer. Sell when you are ready to sell.
And if somebody else finds you interesting, chances are there's
other people,
4 other suitors out there for you, so it might be worth exploring. You probably only sell your agency once, and then you do your non-compete and 3-year earn-out, and then you might build another one. But you know, it's a pretty major event.
And if you think, therefore, about other events in your life, buying a car or other expensive purchases that you would make, you wouldn't just go to one car company and test drive that car. You'd go and talk to a number of different car companies. So you want to open yourself up to as many potential buyers as possible in a structured way, and having professional guidance so you can work out different deal structures. It gets very complex.
Okay, Dan, thank you. I'm just going to take one final question then.
Very, very small question. Awards are no value driver, am I right? With your
We can't
chart?
quite hear you. Can you
Awards are not a
Awards.
value driver in your system,
I
Dan.
wouldn't suggest that an award would necessarily add to your multiple.
Not an
but
award, but being the number one in the creative ranking for 10 years.
Certainly doesn't hurt.
No,
And it means that people are more likely to have heard of you and be interested in you.
But it does not, has no influence on the
It
multiplier.
doesn't fit into the formula necessarily in quite that way. It's not, you know, it's not like I'll get an extra 0.1 because I've won this award. It just doesn't really work like that. But if there's more of a buzz about you, I mean, we always advise people in the lead up to say if you can up your own PR, create some buzz, win some awards, because we know there's a lot of effort that goes into those. You don't just get them for doing the best work. You know, it's worth doing, certainly.
Okay, we're going to have to end it there because of time, but perhaps the conversation can continue
Yeah, of course.
after the session. Thank you very much indeed. Big round of applause, please.